Hey y'all, and welcome to the Birmingham Real Estate Investors Roundup. This is the 7th episode of this show. And on the show, what we do is look at real life case studies of deals that my clients have done. A lot of my clients are real estate investors, and so we'll look at a deal that one did today for a 20-unit apartment building. It's a really cool deal, really cool story. And I think we can learn a lot from this case study. And then we've also got new inventory. We've got a new listing that is coming available today that I will talk to you a little bit about. My name is Rob.h.drum. I'm a real estate broker at eXp Realty here in Birmingham, Alabama. And let's go ahead and get started. We've got kind of a lot to cover today. Again, we're going to hit a case study on a 20-unit apartment building, and then a new turnkey rental property in Roebuck. And I am having a webinar on buying turnkey properties, turnkey rental properties here in Birmingham, Alabama, properties that are rent ready or already rented and professionally managed and in pretty good shape that should provide solid real estate returns to you. So that's what we're going to be talking about on the 23rd of this month. You can sign up at robert.h.drum.us/webinar. I'd love it if you guys would subscribe to this channel. I've got a really good response on these real estate investor roundup videos, so thank you for that, and I will keep them coming. So getting started, before we get into this apartment deal, I wanted to just go over a primer on how commercial real estate is valued, because it is different than residential homes. Commercial real estate is valued based essentially on this equation right here. And let's see if I can get it later here. This equation right here. So I'll break down what these components are. Net operating income, NOI. That's basically what's left of your revenue after you pay all your expenses, after you pay your property management, you do your maintenance, you pay your taxes, your insurance, all the expenses that are involved and associated with a rental property, you pay those. So you've got your rent coming in, you pay all your expenses. What you have left is your net operating income. And that is available to pay debt service or as an owner's distribution that you can pay yourself. So you take that net operating income, that goes there, and then you've got your cap rate. And that is a little more of a kind of, fuzzy intellectual concept, but it essentially answers the question, what rate of return will an investor demand for this property? And it's affected by a lot of different things. It's kind of when you're evaluating a property, it's kind of subjective, but at the same time, once you've purchased it, it's a concrete number. So you'll see, I think this will make more sense when I show you the example, and I'll break down exactly what the numbers were for this 20-unit apartment building. But the cap rate is affected by the property type, location, it's affected by the macro rate environment. So a lot of people watch, say, Fed funds rate or 10-year treasury rate. And as that goes down, cap rates will tend to go down, which lower cap rates, if you can kind of see how this works, lower cap rates lead to higher prices. And as Fed funds rate or 10-year treasury, as those kind of macro rates go higher, cap rates also go higher. So higher cap rates leads to lower prices. So that's just kind of a general overview. I think if that seems like it is a confusing concept, just wait and look at this example. I think it'll make more sense. So what we have is a 1031 exchange. This client had a home that I believe it may have been his primary residence at one point, that he had owned for a number of years in a more expensive market, and it had appreciated from where he bought it. And so he had some potential tax liability, which he wanted to avoid, and because whoever wants to pay taxes. So he was selling that property and wanted to perform a 1031 exchange into either a portfolio of single family homes here in Birmingham or potentially an apartment building. And this one had been under contract. It fell out of contract and was back on the market. So we evaluated it pretty quickly and ran the numbers, made sure that it would kind of work time frame wise, and wrote an offer that we hoped would be pretty compelling for the sellers. So this is a fully stabilized building. There's I'd say the rents are roughly at market rate. The whole building is in pretty good shape. I would call this, close to kind of a turnkey apartment purchase. The previous owners took really good care of it. There wasn't a lot of deferred maintenance, and it was fully occupied. There was, a history of really high occupancy throughout the last couple years. Just so a really well managed and maintained building, built in 1974. The purchase price was $1,150,000. Gross rents for the property were $160,000 roughly, and the net operating income, I don't remember the exact number, but it was within 5 or 10% of 80,000, which I guess I'm guilty of using the rule of thumb of a 50% expense ratio on residential properties like this. I know it works really well for single family homes and apartment buildings. Definitely this size. I think it works honestly even up to larger apartment buildings. Just looking at pro formas and annual reports on some of the larger buildings, it seems like it's going to be close to 50%, give or take in a given year. May go up or down, but that's a rough rule of thumb that seems to play out, over time. It works as an assumption for me. So what that gives you, 6.95 cap rate, and here's how you get that. We have this is again our equation that we were looking at, the net operating income of 80,000. We have the purchase price, and we have the cap rate. So if you divide 80,000 by 6.95%, you get 1,151,000 or so. So roughly this price. So that's kind of how that all works. And that's what we purchased the building for. That's what it, kind of a summary of this deal. Now, on the return side, I'm going to kind of get in the weeds here. So I'm going to put it all together as far as, why is this a good deal? What could you expect for a purchase like this? So we have annual debt service, and there's some assumptions here. Obviously, this is forward-looking statements, but I feel like these are all fairly conservative numbers here. It's nothing out of the ordinary. Annual debt service of approximately 70,000, and that's assuming a 4.5% interest rate and a 20-year amortization, which is roughly what I'm seeing from commercial banks here in Birmingham. That's who ended up funding this one, was a local commercial bank, and that's about what you can expect to get from one of those banks in the current lending environment. Now, the 70,000 debt service, you think, okay, there's 80,000 available for debt service, and there's 70,000 being paid out. So he's looking at about 10,000 of free cash flow available for the year. And for some people, that does not sound very good to them for a purchase this size. And I understand that, but I think what you have to realize about real estate, and especially about rental properties, is that there are a number of aspects that are valuable and a number of ways that you can create value, build your net worth, and succeed in your investment other than just the year one cash flow that's coming into your pocket. And I'd say, if anything, that's probably one of the smallest factors in a successful investment. It's really a time thing. And we'll get into the lessons learned from this, but I just want to point that out because seems like a small window of cash flow, and 3 AC units going out this summer could knock out all 10,000 of that cash flow spread. And so that's something you need to be prepared for with reserves also. But of that 70,000, 29,000 is going to be principal that's getting knocked off that loan in the first year. So a loan size, I think it was around 920,000. It's going to be down to almost 890,000 after 1 year. So that's directly going into the owner's net worth. And let's just say you increase rents with inflation, which the Fed says inflation's at 2%. A lot of things are appreciating way faster than 2%, but that's the number that they give us. So let's just say you achieve increased rents of 2%. That's an extra $1,600. And if you, again, apply, this kind of goes into that cap rate formula also. So if you apply that new net operating income and divide that by 6.95% cap rate, you're adding 23,000 in appreciation. And then the other aspect that is, I think, often overlooked, especially by newer investors, is the depreciation. And on these apartment buildings, that's one of the best reasons to own them, is for the depreciation. So let's just say the land in this equation is 150,000 of the purchase is land. The other $1 million is in the building, and that building is going to be depreciated over 27.5 years, which gives you 36,000 in depreciation losses that you get to show to the IRS that you are losing money, when it's actually kind of just a paper loss, and it's not actually coming out of your pocket in any way. So this showing losses obviously has a value. And that value, it depends on a couple different things. It depends on your personal tax rate. It depends on what else you have going on real estate wise and how you can apply those losses or carry them forward or back, or there's a lot of different things. And that's why it's important to have a great CPA if you're going to be doing this type of thing, to advise you on how to utilize this depreciation to the fullest amount. You can also pull it forward and take a lot bigger percentage of it in the first couple years, but that's kind of another story for another time. But so how you value depends on all these things, but let's just say you are writing this 36,000 off against gains that you would have paid 25% tax rate on. That's about $9,000 of value that you're getting from this depreciation. So hopefully I didn't lose you there. The total for year one is 10,000 cash flow, 29,000 in principal pay down, and 23,000 in appreciation, and then 9,000 in depreciation savings, roughly 71,000 in value. And let's say if you put 250,000 down on this property, you're looking at a kind of total value coming to you in the range of 25 to 30% year one. And that is going to get better. You're going to pay down more in year two. Hopefully your rents will continue to appreciate while your payment stays the same, which gives you more cash flow and all the beautiful things that happen with rentals over time. So lessons from this deal. Buying multiple deals at once is a good way to go if you can afford it. So this buyer actually is the second apartment building I've helped him buy, and he actually surpassed me in unit count with these two buildings and a couple single families, and it's only just a handful of deals. So it's really informative, I think, that you can be efficient with the deals that you do, and try to take down a number of them at once. And it's something to definitely consider about. It kind of made me think a little bit about my own portfolio and how to grow. Also, most commercial banks will not lend to out-of-state borrowers for deals like this. It's a problem that I've run into a good bit. I really need, we kind of had to really finagle it to make this one work. I need a lender who will do that. So if you know somebody who's like a national lender, who's able to lend based on, who is able to lend to out-of-state borrowers, send me an email or send me a text. My information is down here at the bottom of this slide. Would definitely like to be in touch with anyone who is interested in making those type of loans. The other thing is owning property plus time plus 1031 equals monopoly. So this buyer, had a single family home that he may have lived in at one point, turned into a rental, turned into, after some time, appreciation, pay down, all the good things that are happening here, added a 1031 in there, and then all of a sudden that one house turns into a 20-unit apartment building. And in another 10 years, maybe that turns into a hotel. Who knows? If you're familiar with monopoly, which I think most of us are, you kind of know how that goes. And this is what we're looking at, I feel like, is monopoly in real life. And so it's really cool to see. So if you're looking for that kind of first single family house to get you started and start your real life monopoly game, we've got a listing here that I think is really great potential, first property or next property to add to your portfolio and continue to grow. It's 900 Meadowbrook Drive. This is going live today. It's in Roebuck, which is one of my favorite parts to own single family rentals here in Birmingham, not far at all from that 20-unit building that we just looked at. This is built in 1951, a little over 1,100 square feet, 3-bedroom, 1-bath on a great corner lot, freshly painted on the outside here. It's currently rented at $895 per month. Professional management is in place. This this property was renovated in 2018, has a AC unit, was new as of 2018. And this is listed at $94,000. So a pretty good rent to value ratio there. And if you're interested in this, if you'd like to add this to your property, you can send me an email at robert.h.drum@gmail.com. Here's some more pictures of it. Another of the outside. You can see tenants are really maintaining it pretty well, keeping it pretty clean. And again, it was renovated in 2018, and really a quality property to add to your portfolio if you're looking to grow here in Birmingham. So send me a email or a text and let me know if you're interested in that. And if you want to just learn more about buying turnkey rentals like that one here in Birmingham, Alabama, you can sign up for the webinar on the 23rd of this month. And I'll give you kind of the full scoop of how we do that, how I work with clients on those properties, and kind of maybe run through some more case studies, some more examples. I'd love it if you would like this video. Thank you all for watching. Thank you for subscribing and liking and all that. And hopefully you got something good out of this today. I do the Birmingham market update every Friday, and that'll be coming out Friday. So I'll see y'all then. And until then, y'all have a good one.